If you own a home and you're over 60, what I'm about to tell you in the next few minutes could save you or cost you thousands of dollars. The IRS just quietly dropped a set of brand new rules specifically targeting senior homeowners, and they go into effect on May 1st, 2026. That's not far away. And most people, they have absolutely no idea this is coming. Now, I'm not here to scare you, but I am here to make sure you're not caught off guard when tax season hits, and suddenly the rules you've been playing by for years don't apply anymore. Here's what's making a lot of seniors nervous. These changes could directly affect your property tax exemptions, your home equity situation, and even how certain benefits are calculated. And the tricky part? The details are buried in language most of us were never meant to understand easily. So stay with me through this entire video, because I'm going to break it all down in plain English. No jargon, no confusion. If you leave early, you might miss the one piece of information that changes everything for your financial future. Let's get into it. So let's start from the very beginning, because if you don't understand the foundation of what's changing, the rest of it won't make sense. And trust me, you want the full picture here. For decades, senior homeowners in this country have enjoyed certain protections, certain tax advantages and exemptions that were put in place specifically to help older Americans stay in their homes without being crushed by rising costs. These weren't gifts, they were earned. Through years of working, paying taxes, raising families, and building lives inside four walls that you called your own. And for a long time, the system, as complicated as it could be, at least had some stability to it. You knew roughly what to expect. You knew where you stood. But here's the thing about tax law in America. It never stays still for long. And when the IRS decides to move, it doesn't always send you a personal letter. It doesn't knock on your door. It posts updates in dense legal language on government websites that most of us would never think to check on a Tuesday morning. And by the time the average homeowner finds out something has changed, they're already behind. That's exactly what's happening right now with these new rules taking effect on May 1, 2026. And the reason I want you to understand the full context is because these aren't just minor adjustments. They're not just a tweak here or a decimal point moved there. These are substantive changes that affect how senior homeowners are categorized, assessed, and taxed. And in some cases, how your home equity and income are evaluated when you apply for certain federal assistance programs. Let's talk about who this actually affects, because that's usually the first question people have. And the honest answer is broader than most people expect. If you are 62 or older and you own your home, whether it's fully paid off or you still have a mortgage, these new rules apply to you in some form. If you are receiving any kind of Social Security retirement benefit and you also own property, you need to pay attention. If you have ever considered a reverse mortgage, or if you already have one, this update directly touches your situation. And if you're someone who has been relying on state-level senior exemptions to reduce your property tax burden, these federal changes can interact with those state rules in ways that create unexpected gaps in your coverage. Now, I want to pause here for just a second, because I know some of you are already feeling a little anxious. Maybe your heart rate picked up slightly. Maybe you're thinking about your fixed income, your monthly budget, the fact that costs keep going up and the numbers keep getting tighter. I understand that feeling. And I want you to know, this video isn't designed to make you panic. It's designed to make you prepared. There is a massive difference between those two things. Panic makes you freeze. Preparation makes you act. And right now, action is exactly what's needed. So let's keep going, because there are several layers to what the IRS has announced, and each one matters in a different way depending on your specific situation. The first major area of change has to do with how the IRS is redefining what counts as primary residence income impact for senior households. This sounds technical, I know, but stay with me because the real-world meaning is actually very clear. For years, there have been exclusions in place that allowed senior homeowners to protect a significant portion of their home's value from being counted as a taxable asset or income-generating resource. These exclusions existed because lawmakers recognized that your home is not the same as a stock portfolio. It's not liquid. You can't just sell off a bedroom when you need cash. You live there. It's your life. But under the new framework the IRS is rolling out, there are tighter definitions around what qualifies for those protections, and the income thresholds that determine who gets full protection versus partial protection versus no protection at all have been recalculated. What this means practically is that some seniors who previously qualified for certain exemptions may now fall into a different category, not because their situation changed, but because the measuring stick changed. And when the measuring stick changes, the numbers that were comfortable yesterday can become numbers that create real financial pressure tomorrow. The second area, and this one catches a lot of people off guard, involves home equity and how it's treated in the context of federally linked benefit calculations. Now, here's where it gets a little complicated, but incredibly important. There is a long-standing debate in tax and benefits policy about whether the equity you've built in your home should be considered a form of wealth that affects your eligibility for certain programs. In the past, that equity was largely shielded. Your home was your home. Its value didn't count against you in most benefit calculations as long as you were living in it. The new IRS guidance, combined with updated coordination rules between the IRS and certain federal agencies, is changing how that equity is viewed in very specific circumstances. We're talking about situations where homeowners are taking equity out of their homes through refinancing, home equity lines of credit, or reverse mortgage disbursements, and how those transactions are reported and categorized for tax purposes. The rules around what counts as income, what counts as a loan, and what triggers a taxable event have been tightened. And if you've been using your home equity as a financial tool to supplement your retirement income, you need to know exactly how these new rules apply to your specific arrangement. The third area of change is around estate and inheritance implications for seniors who plan to pass their homes on to children or grandchildren. This has been a deeply emotional topic for so many families. The idea of leaving behind something tangible, something of value, something that says, "I worked hard my whole life, and I want you to have this." That means everything to a lot of people. And for years, there were provisions in the tax code that made it relatively straightforward for a home to pass from parent to child without triggering a massive tax burden on the recipient. Some of those provisions are being restructured under the new IRS announcement. The rules around what's called the step-up in basis, which is the mechanism that determines how your home's value is calculated for tax purposes when it's inherited, are being looked at more closely. For some estates, this will have very little impact. For others, particularly those in areas where home values have risen dramatically over the past decade, the difference in how basis is calculated could translate into tens of thousands of dollars in tax liability for whoever inherits the property. That's not a small thing. That's the kind of thing that can force families to sell a home they wanted to keep. Now, before you feel overwhelmed, and I know this is a lot of information, I want to remind you of something important. The fact that you're watching this right now, the fact that you're paying attention and trying to understand what's happening, already puts you ahead of the majority of people in your situation. Most people won't find out about these changes until they're sitting across from a tax preparer in February of next year. And by then, the window to make smart adjustments will have partially closed. You still have time, but the window is open right now, not 6 months from now. So let's talk about what you can actually do with this information, because knowledge without action is just stress. And I don't want to hand you a bag of stress and send you on your way. I want to give you a map. The single most important thing you can do right now, today, this week, is get a clear, written snapshot of your current financial and property situation. I mean that literally. Sit down and write out what your home is worth, what you owe on it if anything, what your monthly income looks like from all sources, and what exemptions or deductions you currently claim on your taxes related to your home. You don't need to be an accountant to do this. You just need to have the information organized and visible. Because when you sit down with a tax professional, and I'll talk about that in a moment, having this information ready will save time and make the conversation far more productive. The second thing you need to do is stop assuming that what worked last year will work this year. This is genuinely one of the most dangerous assumptions a homeowner can make when tax law changes. The instinct is understandable. If you've been filing a certain way for 10 years and it's always been fine, it feels strange and unnecessary to question it. But tax law is not loyal to your habits. It doesn't care that you've always done it this way. What matters is what the current rules say, and the current rules are changing on May 1st. The third thing, and this is where I really want you to lean in, is to specifically seek out a tax professional or a financial advisor who has experience working with senior homeowners. Not just any tax preparer. Not the seasonal office that opens up in January and closes in April. You want someone who understands the intersection of retirement income, property ownership, Social Security benefits, and estate planning. These areas all connect to each other, and a change in one area can ripple through the others in ways that aren't always obvious. A qualified professional who works with clients in your situation will have already been briefed on these new IRS rules and can tell you specifically how they apply to your life. Now let's circle back to something I mentioned earlier, because I think it deserves its own moment in this conversation. And that's the emotional weight of homeownership for seniors. This isn't just about numbers. It never really is. Your home is where you raised your family, or built your marriage, or spent the years that shaped who you are. It might be the one thing you own outright, the one stable thing in a financial life that feels increasingly unpredictable. So when government agencies start talking about rules and assessments and recalculated thresholds, it doesn't just feel like paperwork. It feels like a threat to something deeply personal. And that emotional dimension is actually part of why these rule changes can be so damaging if people aren't informed. Because when we feel emotionally connected to something, we sometimes avoid looking at it too closely, afraid of what we might find. We put off the appointment with the financial advisor. We file the same way we always have. We tell ourselves it'll probably be fine. And sometimes it is fine. But right now, in this specific moment, with these specific changes happening on May 1st, fine is not a safe assumption. Awareness is the only protection. Let me also address something that comes up frequently when senior homeowners start learning about IRS changes. And that's the question of whether these rules affect people differently based on where they live. The answer is yes, and it matters. Federal tax law sets the baseline, but every state has its own layer of property tax rules, senior exemption programs, and income-based relief programs that interact with federal guidelines. Some states have very generous protections for senior homeowners that will continue to provide a buffer even as federal rules tighten. Other states have thinner protections, which means the federal changes will be felt more directly and more immediately. If you live in a state with a strong senior homestead exemption program, you may have more cushion than you think. But you need to verify that, not assume it. Call your local county assessor's office. Check your state's Department of Revenue website. Ask your tax professional specifically about state-level protections in your area. There's also a conversation worth having about the reverse mortgage situation in particular, because this is one area where the new IRS rules are creating the most confusion and the most concern. Reverse mortgages have been marketed heavily to seniors as a way to tap into home equity without selling the home. And for some people, in the right circumstances, they can genuinely be a useful financial tool. But they've also been misunderstood, misused, and in some cases, misrepresented. The new IRS guidance is taking a harder look at how reverse mortgage proceeds are classified and reported, particularly in situations where those proceeds interact with income-based federal programs. If you have a reverse mortgage, or you're considering one, this is not a decision to make in isolation. Get professional guidance. Understand exactly what the tax implications are under the new rules before you sign anything or draw any funds. One more thing I want to make absolutely clear before we get to the end of this video, and that's the timeline. May 1st, 2026 is not a distant date on a calendar. It is close. It is real. And the administrative machinery of the IRS does not wait for people to catch up. Once a rule takes effect, it takes effect. There's no grace period for people who didn't know. There's no, "I didn't hear about this" exception. The responsibility falls on the taxpayer, on you, to be aware of the rules that govern your situation. That's always been how this system works, and it's unlikely to change. Which is exactly why videos like this one matter. Which is exactly why conversations between neighbors, between adult children and their parents, between friends at church or at the community center, matter. Because the IRS is not going to come and explain this to you over coffee. Someone has to do that work, and right now, that's what we're doing together. I also want to say something to the adult children and caregivers who might be watching this alongside a parent or on behalf of one. You are doing something genuinely important by staying informed about rules that affect the people you love. The financial security of a senior parent is not just their concern. It affects the whole family. If a parent is blindsided by a tax rule they didn't know about and suddenly faces an unexpected liability, that ripple goes everywhere. So if you're in this conversation as a supporter rather than the primary homeowner, your role here is real. Help make the appointment. Sit in on the meeting with the tax advisor. Help review the documents. This is meaningful, practical love in action. As we get close to wrapping up this video, I want to leave you with a feeling, not just a set of facts. I want you to feel the way you feel after you've made a doctor's appointment you'd been putting off, or after you finally called that attorney you'd been meaning to call for months. That relief. That sense that you're doing the responsible thing, the adult thing, the thing that future you will be genuinely grateful for. That's the feeling I want you to walk away with today. You watched this video. You stayed to the end. That tells me something about you. It tells me you take your financial life seriously. It tells me you're not the kind of person who buries their head in the sand and hopes things work out. You're the kind of person who wants to understand, who wants to be ready, who wants to make smart decisions with real information. And that quality, that commitment to being informed, is genuinely one of the most protective things you can have in a world that keeps changing the rules on you. So take what you've learned here today and turn it into action this week. Get organized. Make the call. Ask the questions. Don't let May 1st arrive without knowing exactly where you stand. Because your home, your finances, and your peace of mind are worth every bit of attention you can give them right now. Thank you for watching the whole way through. If this video helped you, share it with another senior homeowner in your life who needs to hear this. And if you have questions, drop them in the comments below. We're all navigating this together, and no question is too small when it comes to protecting what you've worked your whole life to build.